Today, we delve into the world of Volkswagen AG, a prominent player in the global automotive industry. Volkswagen is producing and selling vehicles across the globe. It's not just about traditional automobiles for this German giant. Volkswagen AG is also making strides into the future with its ventures into electric vehicles and digital mobility solutions. Now that we have a grasp of Volkswagen AG's operations, let's examine the financial structure of this automotive giant. A balance sheet, a snapshot of a company's financial health, presents a clear picture of Volkswagen AG's financial stability, so let's delve into the details. First off, we have the assets. These are resources owned by Volkswagen, and they're divided into current and non-current assets. Current assets are those expected to be converted into cash within one fiscal year. This includes cash and cash equivalents, inventories, and other short-term assets. Non-current assets, on the other hand, are long-term investments that Volkswagen expects to reap benefits from for more than 1 year. Here we see significant investments in property, plant, and equipment, reflecting the company's production-oriented business model. Moving on to liabilities. These are obligations that Volkswagen needs to pay off. Like assets, liabilities are also divided into current and non-current categories. Current liabilities are debts due within 1 year, including accounts payable and other short-term debts. Non-current liabilities consist of long-term financial obligations, such as bonds payable and long-term lease liabilities. Lastly, we have equity, often referred to as shareholders' equity or owner's equity. This represents the residual interest in the assets of Volkswagen after deducting liabilities. It essentially shows the net assets owned by the shareholders. So there you have it, the three fundamental components of Volkswagen's balance sheet: assets, liabilities, and equity. Each component tells a unique story about the company's financial health and stability. The structure of Volkswagen's balance sheet reflects the capital-intensive nature of the automotive industry, with significant investments in non-current assets and a substantial amount of liabilities to finance these assets. The income statement, another crucial financial document, reveals Volkswagen AG's profitability. It's structured to show us a clear picture of the company's revenues, costs, and ultimately, its net income. Let's start off with the revenues. These are the money makers, the total amount of funds Volkswagen AG pulls in from sales before any expenses are subtracted. It's the top line of the income statement and a great starting point to understanding the company's performance. Next, we've got the cost of goods sold, or COGS. This represents the direct costs of producing the cars that Volkswagen AG sells. Subtracting COGS from revenues gives us the gross margin, a useful measure of production efficiency. Then come the operating expenses. These include everything from research and development to administrative costs. Anything that isn't directly tied to the production of cars but is necessary for running the business falls into this category. Now, if we subtract these operating expenses from the gross margin, we get the operating margin. This gives us a sense of how well Volkswagen AG is managing its costs and operating its business. Finally, after accounting for interest and taxes, we arrive at the net income, or the bottom line. This is the amount of money Volkswagen AG has earned after all expenses have been paid. Volkswagen's most significant expenses typically revolve around the manufacturing and marketing of their vehicles, while their primary revenue source remains the sale of their diverse range of automobiles. Despite the challenges posed by the global automotive industry, Volkswagen AG continues to generate substantial profits, underscoring its resilience and robust business model.